G'day folks, welcome back to Pete's Investing. It's March 9, the weekend, 2024. This is the natural gas price update, also including the ETFs for Boyle, UNG and KOLD. Now the current commodity price is overall bearish in movement, but just watch for a Fibonacci retrace to the upside in the short term. So natural gas has bounced off the 50% Fibonacci retracement, potentially signifying the end of a retracement. A break above 196 level could trigger a bullish rally, aiming for 211 and potentially higher. However, a drop below 176 could lead to a deeper retracement towards key support at 158 at the very least. This is the natural gas commodity price. I've got three charts for those new to the channel. I've got the weekly, daily and hourly. And on all time frames, the ADX 25 is showing a bearish movement on the weekly, and you can see there on the daily, it's just broken up in bearish as well. And on the hourly likewise. Now, in terms of the CCI 150, which is our divergence indicator, and we use this to trade on the lower time frames as well, and I'll explain that at the end of the video, so just hold on for that trading idea. You can see there the CCI 150 is moving towards the moving average bands, and that could be a start of a potential, we need to see it break above those bands to be more bullish, like it did back here. At the moment, it's still in bearish territory, so if it enters those bands, we need to see it break higher on the weekly. On the daily, it's already broken up past those bands, and I'll explain again how you could have traded those going long on the lower time frames. But again, just be careful, it's now entered back in those bands, so avoid going long in the short term. And also, if you, again, for those new to the channel, we've got these arrows, these blue arrows, in signifying a potential reversal, and red arrows signifying a reversal to the downside. Now, on the daily, you can see there's a cluster of, I like to using these cluster of arrows in line with the divergence. You can see there was a small bullish divergence versus lower lows on the price in amongst those arrows showing a bullish movement, and actually went up. So I just use those in conjunction with that divergence. On the hourly time frame, let me just zoom out here for a minute. You can see there we're still bearish on the ADX. The CCI is also broken down. We did have a bearish divergence back here with lower highs on the CCI versus higher highs on the price, and also in conjunction with those, a lot of those bearish candles, arrows, that was signifying a potential decline. It eventually did. I drew a trend line here, and that would have been an area you would have taken that short trade when in conjunction with that bearish divergence. It would have broken down, and as at the moment, it's actually leveled off, and I'll draw a Fibonacci retracement from that low to that high. So our target area for that divergence was the 23-38% level. Sometimes it goes deeper, and you can see here it actually bounced off the 50% level. Had it gone down and broken down past the 61% more substantially, that would have been a threat, and that's where we are at the moment. This could continue further to the downside possibly, or we might be seeing a start of a fifth wave of a Elliott wave. Let me draw that for you as well to remove that. So let me remove some, just maximize this and show you the potential Elliott wave pattern. So if we started back here with an Elliott wave at that low, that would have been the first leg, second, third, and fourth. And the fifth yet to achieve. So this could be the start of a break to the upside. So and the way we measure that is if we draw a Fibonacci expansion from that low to that point there. So we're looking at a potential break somewhere in that region at the very least, if this continues and it breaks higher. Now, before we get too excited about this, I'd like to see this Fibonacci retracement between that low and that high. It's a bit hard to read now because I've drawn that. Let me just remove the Elliott wave. So you can see there, we need to see it break much higher than that 61%. So I always look at the closest Fibonacci range to be able to estimate a break above it. If it breaks above the 61% of that Fibonacci range, then that's a positive, because it could always go up to, for example, a 38 or the 50% and bounce back down again. In this case, and it will be in small waves, by the way, we will have smaller Elliott waves in this pattern, even though it's the hourly time frame. But we need to see it ultimately break higher than a 61% Fibonacci retracement to be more confident. And if it does break higher than that, then we're looking at getting prices close to breaking past this resistance, which will be our next level of resistance, and then somewhere up around the 123 level Fibonacci. So next we'll look at Boyle, which has got a similar pattern to the commodity price, but notice on the weekly it's showing a bearish movement on the ADX, which with a bullish divergence on the weekly versus very much a flat movement or a downward movement on the price chart on the weekly. So bullish divergence there. Hasn't made any real change to the upside yet. On the daily, be careful about trading long on the smaller time frames, because notice on the daily we're broken into this band. As I mentioned, if it's in this band of moving averages, avoid taking any trades, long or short. Ideally, and I'll show you the trading strategy at the end of the video, how do we trade this when it breaks above the band. But at the moment you'll see we did have a bullish divergence. We had a few versus a bearish movement on the price, and we had a few clusters of blue arrows indicating a potential upswing. So you would have waited for this divergence to play out, and currently it's still moving up, and for that to play out and hit our target, we expect that to hit. If it keeps moving up, of course there's no guarantees, it's going to hit this 23 to 38% target level, and I'll draw the target level in there as a reference point. That's our initial target. Now this could always just bounce to the downside and continue further down. As we said, there's no guarantees. On the hourly chart, that's on the daily. On the hourly chart, similar to the natural gas commodity price, we did have actually there was not really a bearish divergence, but if you follow the natural gas commodity price, it had a similar pattern. It broke down through this trend line, and that would have hit, again, if I draw a Fibonacci on that, you can see there it's broken and resting around a 61%. That's key. So again, if it falls much further than that, we're going to see a weaker Boyle price drop even further. So we need to see it bounce from there potentially. And again, to be more confident of that, I won't draw too many Fibonacci's, but you get the idea. We need to see, if that starts moving up, we need to see that break above the 61% to be more bullish. At the moment, hold your horses, and we need to see more bullish action before we get too excited. Notice on the hourly, it's also bearish, so avoid taking long trades. We need to see that break above the moving average band on the hourly, but again, and also I'll demonstrate in the trading idea, but we need to see the daily especially break higher. Next, we've got the ProShares Ultra Short, KOLD. So we've got here the ADX we start off with. It's bullish on the weekly, bearish on the daily, and bullish on the hourly. But you'll notice we've got a bullish movement on the ADX. The CCI 150, strange pattern, but it's actually moving in line with the price. The price is going up, and so is the CCI, so no divergence really. On the daily, we've got lower highs there on the CCI versus higher highs, so that was a bearish divergence and actually broke down, hit our target. Notice there it actually rested and bounced off the 61%. So that 61% is key. It could always bounce up from any range, but that is key. If it breaks below that more significantly, we would have had further declines. On the hourly, again a small bullish divergence there versus lower lows on, albeit very slight, lower lows on the price, and it bounced up. And again, drawing a trend line, that would have been a nice little area to go long, but again a risky trade only based on the hourly. But I would have avoided going long at that point, because you can see there the daily, which we always trade based on the higher time frame. The daily is still bearish, and it's within that range, so I would not have taken any long trades on that one. Lastly, on UNG, bearish on the ADX, just fresh breakout on the bearish on the daily and bearish on the hourly. Again, similar patterns. I won't go through all the Fibonacci's, but you get the idea. We had a bullish divergence there on the daily, and you would have traded that similar to the natural gas commodity price when it broke down. Similar pattern as well. That would have been around the 61% or 50% possibly Fibonacci retracement between that range. We want to see it break much higher to be more bullish, but again, see the daily break higher and the hourly break outside of that moving average band. In terms of the trading idea, as promised, what we look at is the daily chart. If you're trading these smaller time frames like the hourly or even the 2 hourly or the 15-minute, you trade based on the direction of the larger time frame. In this case, we're trading the hourly based on the direction of the daily. So I've got here two test cases. I've got the average down approach and the stop loss approach. Before we get into the overall strategy, we trade in proportion to the Heikin-Ashis, so going long when the Heikin-Ashi is green and go short when the Heikin-Ashi is red. So that's the first rule. And the second rule, or the most important rule, is trade only when the daily is broken above the moving average bands here. And this indicator is in the description below with a video to demonstrate it. So reference that once you finish this video. So you trade when the CCI breaks above the moving average band. You take the trades on the lower time frames. In this case, we're trading the hourly. The other thing I want to mention as well is there's a couple of questions on how to draw these arrows, these blue and red arrows. And that's simply based on this indicator, which I showed a video on. Again, it's in the description below. Pete's multiple indicator. No fancy name for it. So when it breaks 3 or above the value, it shows a blue arrow, and I've got just that arrow on the price chart to demonstrate that. But the actual video that in the description demonstrates this indicator, which is what I'm using to demonstrate those arrows. And if it breaks below -3 or less, it shows the red arrows. So that's what helps paint those arrows for those interested. So again, going back to the trading strategy, we take long trades in this case, more recently, when this CCI breaks outside of that band. You can see there on those two charts on the right, the green and the pink chart, that would have taken long trades. So you go long when the Heikin-Ashi is green, only you don't take short trades. Now notice it's actually hit the moving average band at that point. So you would have stopped taking those long trades at that point. So you would have stopped taking any more trades there around that point on the average down approach and also on the stop loss approach. So you can see there the average down approach generated $7,060, if you want to call it dollars or euro, and the stop loss approach generated 2,340. So again, I'll just let you decide which way you want to trade, whether it's an average down or a stop loss approach. I've also demonstrated, just as an FYI, with a bearish trades. So I've got here up here in the red, the very top of each of these charts. Had you traded based on the daily, when it broke below the moving average band at that point there, and you would have stopped taking short trades, especially when you see a divergence. Doesn't always show a divergence, but if you especially see a divergence, you would have gotten out of the trades. And I've demonstrated there with the short trades that would have stopped you would have stopped taking short trades when you saw that divergence. But up until that point, on the average down, it would have generated 2,115. And on the stop loss approach, likewise, it would have generated similar 855. So again, that's just demonstrating the short approach. Stop taking short trades when you see a divergence, but especially if it enters the moving average band, and start taking long trades at that point, and stop taking long trades. So at the moment, you shouldn't be taking any trades. So stay tuned to the very end of the video. This is the first slide. I've got two slides. The first slide is the average down rules. So you can pause the video and read that in your own leisure. And the second slide shows the stop loss rules. Again, pause the video at your own leisure. Thanks for watching. Hit that like and subscribe button. Hit that notification bell, and we'll see you in a future video.